Welcome back. Now, increased financing costs and a higher effective tax rate ate into Spar's full-year earnings. This despite improved overall performance. The group saw higher financing costs linked to legacy Poland debt assumed in South Africa, which resulted in non-deductible interest and a higher effective tax rate. Spar CEO Angelo Swartz joins us now for greater insight into that performance. Angelo, thanks so much for your time today. Now, the second half of the year giving the group a bit of a boost, and over the financial year, we saw a lot taking place, right? The Switzerland unit finally being sold off, the UK exit still in progress, and I'm wondering, with everything underway, is Spar now through the balance sheet clean-up and positioned for further growth?
Well, firstly, thank you for having me. I think that's a very pertinent question. From our perspective, yes, our balance sheet has been cleaned up. As you mentioned, we still need to complete the UK disposal, although we've impaired that asset down to zero. And so I think that it has largely, from a balance sheet perspective, been taken care of. And the business now really refocusing on the two core geographies, being Ireland and Southern Africa as the engines for growth, and in particular, refocusing to the heart of our business, which is our Southern African operations. And I think we are positioned now to drive growth in this business.
We'll get into those two operations in a bit. I just want to focus on the balance sheet. We did see debt being reduced from 9.1 billion rand to 5.4 billion rands on the back of the sales proceeds, of course. Talk to me about gearing levels in greater detail and how comfortable you are. I know the group has a goal of getting debt down to 2 billion rands.
Well, I'm not sure we've articulated 2 billion rands, but definitely getting levels to under 1.5 times EBITDA. And so South Africa would be probably around 2 billion. From a group perspective, we'd like to get that down to 1.5 times EBITDA. We've made good progress. So a year ago, the debt level was at about 2.4 times EBITDA. We ended the year up at 1.75 times. And so that reduction has been stock, and something that we're really, really proud of. Ultimately, though, we think a sustainable level of debt for a business like ours is to reduce that debt to under 1.5 times. And I think we'll make good progress towards that.
Angelo, how have the disposal proceeds improved the group's cash position? And maybe take us through your capital priorities moving forward.
So the disposals have certainly helped. I think Switzerland was a business that carried a fair bit of debt, around 150 million Swiss francs, or a bit more than that, 3.5 billion rand. With that coming off, it significantly helped us reduce the debt. Going forward, capital allocation really is going to be focused on maintenance capital, both in Southern Africa and Ireland, or CapEx, as well as CapEx spent on the expansion of our IT systems and modernization and digitization of the businesses, both in South Africa and in Ireland, and the completion of our SAP rollout. And then beyond that, the big priority for us is to start returning cash to shareholders, whether that be through dividends or through share buybacks. Both options are open to us, and we really want to ensure that in the short to medium term that we start returning capital to shareholders, or cash to shareholders, and reward them for their patience with Spar.
And that's exactly what I was going to mention, that it's very important that they do know, the long-term shareholders that have been holding on to those Spar shares, that, in the next, year or two, perhaps that they might get some returns coming through. I want to stick with Southern Africa for a bit. Revenue there grew modestly in a tough market. Just walk us through some of the key levers to lift top line growth while also protecting margins, because we do know that grocery market is a very, very tough market here in South Africa.
Yeah. So I think we as you mentioned, modest growth for the year. In particular, very slow first half of the year. So H2 a lot better. We saw a fair amount of momentum in H2, both in our Irish and Southern African operations. In South Africa, in particular, we saw our grocery and liquor business accelerate in the second half of the year, with growth in that business now up to 3% in H2 from 1.1 in the first half. And that growth has really assisted the business, but also provides some momentum going into the festive season and into next year. As you mentioned, retail in South Africa is becoming crowded, and lots of competition, and excellent retailers in South Africa, world-class retailers in this environment. And so a number of things we're doing to drive growth. One key lever is looking for additional segments to play in, as let's call them horizontal opportunities. Pet being one lever that we've pulled. We've started a pet business and are looking to accelerate the growth in that business. We think there's an opportunity for us to support independent pet stores, our model being primarily that of a wholesaler. And so we think there's a big opportunity there. And then within the core grocery business, differentiation and clarification for consumers about what the stores they shop in standing for. And in that space, we've put a fair amount of effort into redefining our Save More format at the affordable end of the spectrum. And then also, excitingly, in the last 2 weeks or so, we've launched our first Spar Gourmet store, which is our first foray into a formal high-end grocer. And so that differentiation, both at the bottom end of the market and the top end of the market, I think, is going to spur growth and provide opportunities for us as a business. And then also allow us to clarify the market positioning for our core Spar banner by reducing the noise. We are the only retailer who used one banner to talk to all markets. And so these forays into Save More as well as Spar Gourmet will allow us to simplify the brand messaging and brand positioning for the core Spar brand.
All right, let's leave it there. Angelo, thanks so much for your time and taking us through the year that was for Spar. That was Angelo Swartz, CEO of Spar.